You probably think money is created by governments, printed in secret rooms, guarded by men in suits. But that's only part of the story, because most of the money in modern economies, around 97% of it, wasn't printed at all. It was created digitally by commercial banks. Every time a bank approves a loan, for a house, a car, or a business, new money enters the economy, not transferred from someone else's savings, created as a new deposit. So here's the question. If banks can create money when they lend, how does this system actually work? And what does it mean for the economy? What we think money is. We grow up thinking money is simple. You work, you get paid. You spend, you save. Cash, coins, maybe a number on your phone screen. For most of history, money was backed by something physical. Gold or silver stored in vaults. Every banknote represented a claim on real metal you could theoretically exchange it for. But in 1971, that connection ended. President Richard Nixon closed the gold window, severing the dollar's link to gold. From that moment, modern currencies became what economists call fiat money, backed not by precious metals, but by government authority and public trust. This shift didn't just change what money is. It changed who creates it. How banks create money through lending. Here's where things get interesting. Let's say you apply for a $100,000 mortgage to buy a house. The bank reviews your application, checks your creditworthiness, and approves the loan. In that moment, the bank creates a new deposit in your account. It doesn't withdraw $100,000 from a vault or transfer it from someone else's savings. It simply credits your account, creating new money in the process. According to the Bank of England, this is how most money is created in modern economies. When banks make loans, they create deposits, and those deposits are money. Your loan becomes an asset on the bank's balance sheet, money you owe them. The deposit becomes a liability, money they owe you. Two entries, created simultaneously. When you spend that money on your house, it moves to the seller's account. They might deposit it in another bank, which could lend it again. Money circulates through the economy this way, not printed, but issued through lending. The limits on money creation. Now, you might be wondering, if banks can create money by lending, what stops them from creating unlimited amounts? The answer: several important constraints. First, banks need capital. Regulators require banks to hold a minimum amount of capital, their own funds, to absorb potential losses. This limits how much they can lend. Second, they face liquidity requirements. Banks need enough cash and liquid assets to meet withdrawal demands from customers. Third, there's market discipline. Banks compete for deposits because those deposits are still important for their operations and stability. They also need to make profitable loans, lending to borrowers who can actually repay. And fourth, central banks set monetary policy. By adjusting interest rates and reserve requirements, central banks influence how much banks are willing and able to lend. So while banks do create money through lending, they operate within a framework of regulations, market forces, and economic realities. The role of debt in the economy. Because most money is created through bank loans, debt plays a central role in modern economies. When borrowing increases, the money supply expands. When loans are repaid and not replaced with new ones, money is destroyed and the money supply contracts. This creates what economists call the credit cycle. During economic expansions, banks lend more freely. Money is created and spending increases. During contractions, lending slows, less money is created and economic activity declines. That's why central banks pay close attention to credit conditions. When the economy slows, they often lower interest rates to encourage borrowing and money creation. When it overheats, they raise rates to cool things down. This doesn't mean the system requires ever-increasing debt to function. What it means is that the money supply needs to grow roughly in line with economic activity to maintain stable prices and growth. Different countries manage this balance differently, with varying results. Part 6. Who benefits and the broader picture. Credit creation enables economic activity that wouldn't otherwise be possible. Businesses can invest before they have profits. Families can buy homes before they've saved the full price. Governments can fund infrastructure that pays dividends over decades. But there are also costs and trade-offs. Interest payments do flow from borrowers to lenders, from households to banks, from developing nations to creditor countries. For some, debt is a tool for building wealth. For others, it becomes a burden that limits choices and opportunity. Economists debate these dynamics constantly. Some argue that credit-based money creation enables prosperity and innovation. Others warn that excessive debt leads to instability and inequality. The 2008 financial crisis showed what happens when lending standards deteriorate and debt levels become unsustainable. But history also shows that well-regulated credit markets can support broad-based economic growth. The system isn't inherently good or bad. It depends on how it's managed, regulated, and who has access to credit on fair terms. Understanding the system. The modern monetary system is complex, and experts disagree on many aspects of how it works and how it should work. What we do know, banks create most money through lending, not governments through printing. This money creation is constrained by regulations, capital requirements, and market forces. Debt plays a central role, but economies can function sustainably with the right policies and oversight. Understanding how money is created matters because it affects everything: interest rates, inflation, economic growth, and financial stability. The more people understand the system, the better we can debate how to improve it.